So you're thinking about investing, but you're not quite sure where to begin. You've probably heard people throw around terms like stocks and mutual funds, but what's the real difference? Well, in this explainer, we're going to break down both of these paths to help you figure out which one is the right fit for you.
This really is the big question, isn't it? Stocks or mutual funds? Honestly, choosing can feel a bit overwhelming at first, but I promise by the end of our little chat here, you'll have a super clear framework to decide what's best for your own financial goals. So let's start with the basics, the arena where all of this happens. Okay, before we can even compare these two paths, we first need to get a handle on the stock market itself. It's a world of both incredible opportunity and, yeah, some pretty significant risk. At its heart, the stock market is just a place where you can buy tiny pieces of ownership in public companies. These little pieces are called shares. When you buy one, you're basically getting a stake in that company's future success and growth. It's pretty cool when you think about it. Here in India, all this buying and selling happens on major exchanges like the BSE, that's the Bombay Stock Exchange, and the NSE, the National Stock Exchange. Now, you can make money in two main ways, either through price appreciation, that's just when a share's value goes up, or through dividends, which is when a company shares its profits with you. But you've got to remember, the market is swayed by everything from the economy to global news, which makes it, by its very nature, volatile. All right, now that we have a feel for the marketplace, let's explore the two main ways you can jump in. You can either decide to go it alone, or you can go with a team. And I love this analogy because it really gets to the core difference. Investing in direct stocks, that's like being the pilot of your own airplane. You are in total control, which is awesome. But you're also responsible for all the research, the navigation, and every single decision. Now, with mutual funds, you're basically hiring a professional crew to fly the plane for you. This table really lays out the trade-offs, doesn't it? See how direct stocks give you all the control? You're the one calling every shot. That's powerful, but it also means your risk is way more concentrated, and it demands some serious research. On the flip side, mutual funds, well, they delegate all that work to the pros. The risk is spread out, which makes it a much, much smoother entry point for beginners or really anyone investing for the long haul. So it's pretty clear that for a lot of people just starting out, mutual funds are a more accessible path. But what is it about them that makes them so much less intimidating? Let's take a closer look. A mutual fund is basically a collective investment. Just think of it like a big basket. An asset management company, or AMC, pulls together money from thousands of investors just like you, and then uses it to buy a whole variety of stocks and other assets, putting them all into that one basket. And this strategy leads to four huge benefits for you. First is diversification. Your risk is spread out, so you don't go down if one single company has a bad quarter. Second, you get professional management, so you don't have to do all that deep dive research yourself. Third, they're super accessible. You can start with small, regular amounts. And finally, in India, they're regulated by SEBI, the Securities and Exchange Board of India, which gives you a really important layer of protection. Now, the most popular way to get all these benefits and build wealth over time is through a really powerful method called a systematic investment plan, or SIP. You've probably heard of it. So an SIP isn't an investment itself, but it's a method of investing. It's basically a commitment to invest a specific amount of money every single month automatically. It's a simple habit, but it's one of the most powerful strategies there is for building wealth over time. And if you want to know how popular this is, get this. In a recent single month, investors in India poured over 26,000 crore rupees into mutual funds just through SIPs. That is a massive vote of confidence in this disciplined long-term approach. Just incredible. So why does this work so well? Well, first, it automates discipline, which is half the battle. Second, it uses this powerful idea called rupee cost averaging. It just means that when prices are low, your fixed monthly amount buys more units, and when prices are high, it buys fewer. Over time, this actually lowers your average cost and turns that scary market volatility into an advantage. Which brings us to a really crucial point. Whether you choose to pilot your own investments with direct stocks or you hire a crew with mutual funds, your ultimate success doesn't really depend on the vehicle. It all depends on the discipline of the pilot. And this is something you'll hear from financial experts all over the world. Your behavior, your ability to just stick to a plan and not react emotionally to all the market noise, is so much more important than trying to predict the future or find that one perfect stock. So what does that discipline actually look like? Well, it's a process. You start by building a SMART plan. That's points 1, 2, and 3. Allocating your assets, diversifying your risk, and really understanding how much risk you're comfortable with. Then comes the hard part, sticking to it. That means checking in on your portfolio every now and then, and, this is the big one, not letting fear or greed make your decisions for you. Okay, we have covered a ton of ground here. So let's pull it all together into a clear, simple blueprint that you can take away and actually use. Here it is, in a nutshell. Direct stocks, they offer high potential, but they need expertise and a stomach for risk. Mutual funds, a fantastic, diversified way to get started for most people. SIPs, that's your secret weapon for building consistency. And above everything else, discipline is the real engine that's going to drive you towards your financial goals, no matter which path you choose.
So I'll leave you with this final thought. Market volatility isn't some kind of glitch. It's a feature. It's just part of the deal. So the real question isn't whether the market is going to go up or down next week. The real question is your strategy built to handle the ride?